Did you know that in some cases, estate taxes can claim up to 40% of an individual's estate value at death? This significant financial impact is why understanding estate tax is important. In this video, we'll explain the complexities of estate tax, its implications, and how it affects estate planning. Let's get started. What is estate tax? The estate tax, often referred to as the death tax, is a tax levied on the transfer of the deceased person's estate. The calculation of the gross estate is a critical step in determining the estate tax liability. This involves summing up the total value of all the assets owned by the deceased at the time of death. These assets can include cash, securities, real estate, insurance, trusts, annuities, business interests, and other forms of property. Let's consider this example. John, a recently deceased individual, left behind a variety of assets. His estate includes a house valued at $500,000, a stock portfolio worth $300,000, a life insurance policy of $200,000, and a car valued at $50,000. To calculate the gross estate, you would sum up these values. House, $500,000. Stocks, $300,000. Life insurance, $200,000. Car, $50,000. Total gross estate, $1,050,000. This total of $1,050,000 represents John's gross estate, which is the starting point for determining the estate tax liability. Determining the taxable estate. Determining the taxable estate involves subtracting allowable deductions from the gross estate. These deductions may include debts, estate administration expenses, property passing to surviving spouses, marital deduction, and qualified charities. The resulting value is the taxable estate. For example, gross estate value, $1,050,000. House, $500,000. Stocks, $300,000. Life insurance, $200,000. Car, $50,000. Deductions, debts and expenses, $100,000. Marital. Deduction, $200,000, assuming some assets are passed to a surviving spouse. Charitable contributions, $50,000. Net taxable estate, total deductions is equal to $100,000. Debts or expenses, plus $200,000 marital deductions, plus $50,000 charitable deductions, is equal to $350,000. Taxable estate, $1,050,000 gross minus $350,000 deductions is equal to $700,000. Let us now have a look at how the federal estate tax rates would apply to net value of $700,000 as mentioned earlier. Federal estate tax rates. For a taxable amount ranging from $0 to $10,000, the tax rate is 18% of the taxable amount. For a taxable amount ranging from $10,001 to $20,000, the tax rate is $1,800 plus 20% of the amount over $10,000, so on and so forth. Filing requirements for an estate tax. Filing requirements for estate tax generally depend on the value of the estate and the filing threshold for the year. If an estate's gross value exceeds the federal exemption limit, an estate tax return, Form 706, must be filed. For example, if the exemption limit is $11.7 million and the estate's gross value is above this, a return is required. Simple estates, like those with a small amount of cash, a home, and some investments, may not need to file if their value is below the threshold. However, other factors such as state-specific rules and the deceased's past taxable gifts might also impact filing requirements. Thank you for watching our video on estate tax. We hope it provided valuable insights into understanding and managing this complex aspect of financial planning. If you found this information helpful, please consider liking, subscribing, and sharing this video to help others navigate their estate planning. Don't forget to leave your thoughts and any questions in the comments section below. Your feedback helps us create content that matters to you. For more personalized guidance, check out the link in the description to book your free consultation with us. Thanks again, and see you in our next video.